Good morning, guys. Matt from Bailey's Capital here today. So last week we went over credit spreads. So just a refresher, a credit spread is when you're taking a net amount of money in order to put on your option trade, whereas a debit spread is when you're gonna pay for the option and then you get a little bit of money back to offset the cost of it. So I'm gonna go over two examples today. These can be done bull or bear. You're just gonna buy puts or calls in each direction, and then hedge it with an option above or below, depending on what you bought. So what this does is it lowers your actual cost of the trade, but it also decreases your max profitability. So it's just good. It turns your risk reward in a little bit better. So instead of risking like say $700 or so, you're maybe risking 200, and then your max profit goes from infinite, like in theory. So if a stock went to 1,000,000%, you would make that. Whereas with a debit spread, you're only going to be able to make the difference between the two options minus the price that you paid for the option. So I'll go over and explain it. It'll make a little bit more sense. So I'm going to go over two examples today. We're going to do one call spread and we're going to do one put spread. So the stocks that I'm choosing are Twilio. It's on my swing list, actually, I think, for this week. And then we're going to do Boeing for the put list. Again, this is just for informational purposes today. So with this one, we see it's coming off of a kind of consolidation period here. We're getting a curl on the 5 and 10 moving average. We had a nice hammer candle on Friday. So this is looking pretty bullish right now. My trigger would be a break over this like 140.5-ish level, and targets would be 145 and then 150. So the options we're going to choose are, we're going to go with August 16s, and we're going to go with a 145 strike and a 150 strike. So we'll go pull over our dashboard here and take a look what everything says. Okay, so we're going to buy 145 call. So we want to buy like a closer strike price. It doesn't necessarily have to be like a $5 difference or whatever. Like you can go further out on the chain, and that'll bring your cost down even lower. Depending on how confident you are in the move, etc. You can go further out time-wise. It all depends. So we're going to buy 145 call, and we're going to sell a 150 call. So if we didn't purchase this here to offset it, it would cost us $760 for one contract. So in this situation, you're risking $760. And in order to break even on this at expiry, you're going to need the stock to be 152.59 to even break even on that. So you can see like that's probably a little ambitious. Like it's definitely possible, but that's a pretty big gamble in order for it to go to that price. However, if you're still confident on it going 1 to 152, if we buy this one, the 145, and we sell the 150, we're risking $190 after commissions, roughly. And your max profit is going to be at 150. So in this situation, if it closes at 150 on August 16th, you will make $320. Yeah, $320. So how you calculate this is you take the difference between these two, which is $500, and then we're going to subtract our cost of the trade. So our cost is 180. So we're going to be making 500 minus 180. So yeah, you're going to make $320 if it goes to 150. And then if you're right on it going to 152, that would just be your break-even price for this 145 call at expiration. The idea if you were trading the 145, like you would probably want to sell it sooner rather than later in order to keep your theta decay, right? Whereas these ones, you're going to make that all the way up to expiration. And then, so say if you're wrong in this situation, it goes completely against you. it goes down to, like 130, 135, etc. Your total loss is only $180 or $190, sorry. Whereas if you were doing this call, you would lose the full 760 if you were holding to expiration. So a lot lower risk. Your total return is going to be lower, but your probability of the total return will be a little bit higher, just because you don't have to get quite as much of a run at expiration in order to make any money. So that's just some pros and cons of debit spreads. You don't have to do these all the time, but it lets you do more with a lower amount of capital, right? So if it only costs me like $200 here, you know your max loss, which is nice. So you can put on maybe 10 trades with, if you have $2,000, you can put on 10 trades as opposed to if you were trying to just do long options, like you'd only be able to put on 3 if we were just buying these calls here, right? So there's some pros and cons of that. So now we'll go look at Boeing, and we're going to do a put spread for that one. So we'll pull up the chart. Excuse me. So we'll get rid of these lines here. All right. Okay, so this looks kind of like a bear flag. It's hard to tell if this is going to curl up or not. The stochastic is starting to curl, and so is the RSI. In a real situation, I probably wouldn't short Boeing right now until we get a bit of confirmation. So what I would be looking for is for it to pop up to here, like around to test the 360-ish level, and then come back down, or for it to just lose this support here around 351 or so, and then for it to start sinking. That's what I'd be looking for. Anyways, for educational purposes for today, we will do we'll do a 345 put, and we'll do a 340 put for purposes today. So we'll go to August. You could go a bit further out, depending on how long you think the move is going to take to play out. So we'll go look at that. So we're going to pull up Boeing here. So we're going to change these to puts, and we will buy the 345, and we will sell the 340. And we'll change this to August 16th. So when you're doing put and call spreads, I'll change my thing back. You want to go with monthlies typically. You can do lottos and stuff like that. The monthlies just have more, excuse me, more volume and more open interest usually. So when you're putting on one of these trades, depending on which broker you're with, you're usually trying to do it in one order. So you want it to be easier than harder to try and get those orders filled. So if there's more volume and more interest, your probability of getting your order filled is going to be higher. So just when looking at that, usually go with the monthlies as opposed to the weeklies. If you're trading something with high enough volume, like the S&P or whatever, like you're probably okay going with the dailies, or dailies or weeklies, sorry. But just as a rule of thumb, you want to go with the weeklies for the most part. Okay, so buy 345s, sell 340s. Okie dokie. Okie doke. So if we were to buy the 345 here, it's going to cost us $964, and then we're selling the 340 here for $790. So again, it's going to cost us just under $200, and then your max profit is going to be 500 again, right? Sorry, 500 minus your trading costs. So your max profit's going to be somewhere around the just like 320-ish, 315 or so. So you're risking $184 to make $320, and with this situation, your max profit's going to be at 340. So you can spread these out a bit more if you want. So like you could do 335. That's going to increase your cost a little bit. So your cost is going to go up, but your max profit is going to go up to so it's $1,000. So your max profit's going to go up around $700, like 640 or 660. Sorry, math's hard in the morning. So in this situation, you're risking a little bit more in order to make a little bit more, depending on how confident in the move you are. I can't really tell you what strikes and stuff to go with. That's going to be personal preference, but those are just different strategies here. So yeah, and then in the other situation, like you can manage these too. So like if it goes against you, your price of the one you sold is going to go down really quick. So if you think it's going to go down and then pop back up, you can cut, or sorry, in this situation, go up and then go down because it's a put. You can cover your one put and take your profit, and then you can either rebuy it cheaper, or like there's lots of different ways to manage it. In general, we usually want to just leave them alone and let your probabilities and stuff play out. But you know, if you get a really big pop the one day, you can cover that and make a few $100, and then that's going to offset your trade even more so, right? And then you can actually turn it into a credit trade. So say it pops up and I collect whatever, we'll say we'll collect $200 profit, and then it sinks back down, and then you can sell the same put again for the same cost. So say you sell it for $635 after netting your 200 profit, you're actually at a neutral credit now, and you have no risk because you've already locked your profit in. So those are just a few different ways to manage those. Every situation is going to be different, but these are just a good way. You have a max profit, you have a max loss, and your probabilities are slightly higher because you don't need it to move as much to make the trade, right? So like if we bought this one for 345, we need it to go to 335 in order to break even at time of expiration. So whereas with this one, sorry, if we go back to 340, we only need it to go to 340 in order to make max profit, which is going to be significantly higher than your profit if it went to 335, right? Because you're just breaking even at that point. You need it to drop to 330 in order to make 333 to make the same amount as you would with one of the debit spreads. Okay, so yeah, that's debit spreads. In summary, you buy a closer strike, sell a further away strike, it just offsets your cost. It caps your profit at your one that you sold, and your probability of getting your max profit is going to be a little bit higher, but you are not going to be able to make infinite percent on one of these. Okay. All right, guys. Thanks. Let's go make some money. And if you have any questions, just shoot me a message. Awesome. Thanks.